Hello guys, welcome back to another Lumley Trading video. In this one we're going to be looking at HPQ, the trade we took on it, why we took it, and how you can look for similar trades like this one. So firstly, HPQ had earnings, did better than expected, and obviously did push up off this news. So actually I would say, obviously we haven't really been seeing that in earnings. They can kind of react however, but in this case we pushed upwards. Now the key thing, and if you watched the channel before, you'll understand that we trade off standard deviations a lot of the time. And that's what these lines are. These blue lines are second deviations, these green lines are third deviations, and these red ones are fourth deviations. Now these solid lines are 1 year charts, and these dashed lines are 6-month charts. But in a quick summary of standard deviations, the further you get away from this white line, which is considered the statistical mean, the more likely you are to start reversing to it. So first deviation, obviously, you expect that reversal, but it's not that big. But when you start coming to these third and fourth deviations, a reversal move is more than probable. And that's exactly where this trade plan came from. We pushed into these fourth deviations. So as soon as we start pushing into these, I know there's a high likelihood that we're going to trade outside of these zones for a very short period, and before we start trading back inside of this range and start trying to push towards that statistical mean, which currently is at 29.18 and 30.94. So the play plan here was basically get short at the 6-month fourth deviation, because that is our final resistance. You can see third deviation, fourth deviation, fourth deviation. We don't really put any more on the chart past the fourth deviations because very rare that stocks go up to that level, and if they do, there's no point really trading off of them. Fourth deviation will kind of be that final one we just look to trade off. So the trade plan was get short here. If we do a bit more of a further push, we can add some size and really just wait for that kind of move to start crumbling either that same day or coming into the end of the week. And again, this trade was taken on the Thursday. So we got short here, so our average is roughly here. Obviously this did go offside quite a bit, by about 0.20, 0.50, so definitely could have got better execution off here. But again, the rough thing is if we're above this level here, reversal is more than likely. So as long as we're getting short at this price or above, really, we've got quite a good entry. Yes, we could have got better, but in trading you're never going to get a pinpoint perfect entry. So we got short there, and then basically just held it overnight and then sold in coming into the open. The reason we sold in coming into the open was, firstly, we're breaking back below the supports which we are likely to retest. You can see here we kind of broke through, hadn't really retested them. So normally, again, on these reversal plays, that can be our first kind of sense of profit. We will more than likely come back to retest these. So that was kind of our main trade plan, and that's why we locked in profits coming into this to the start of the day. And as well, another thing to note was HPQ was down around 7-8% when we were locking in profits, and on a stock like this, very rare it's going to kind of hold that kind of move. A lot of the times you're going to end up like how it did today and start giving back some of those moves, and that's why we only closed down just under 5%. So that was kind of the main trade plan. Now, how can we take this trade more regularly and kind of don't get stopped out on these? Because obviously we're shorting shares here, we're shorting shares here, that we were short 200 shares. Now, most of the time, obviously, you're not going to run this naked, because obviously if this shoots up to $45 or so, you're going to be down a massive amount of money. So it's how can we kind of control that risk? And the way we did this, and you'll see because we're still holding them now, is by going about 2 weeks out, because again, this move may not happen that same day or the next day, or maybe not even the next week, but normally it will happen within 2 weeks. So we go 2 weeks out, we look, and again, where was price when we started getting short? Around $37 and $38. So what I was looking at on this short move was, okay, we will buy up these 38 calls as protection. And again, you can see we've obviously got a position in here. And what this would do is define our risk. And what it basically means is, obviously, if the price goes above $38, then obviously our shorts will lose money, but these calls will be in the money and they will be creating that value. So if come expiration, so in 13 days from now, we were above that strike, again, we have nothing to worry about. We know what we're going to lose. In our case, we had about $130 on the first. So again, we had to buy these calls separately. We shorted 100 shares here. We bought the 83 call, or 38 call, sorry, and we paid $130 basically for that protection. However, when we shorted here, those calls did increase a bit. I can't actually remember the exact thing. I can't go back and exactly see. But overall, I think our average cost on these were about $115 each. Obviously, you can see they're now worth $25 to $41, depending between the bid and the ask. But again, they're protection, so they're not going to matter completely. These can expire worthless. Overall, we've made money on the trade. Again, we've looked in that profits. This trade is now risk-free, and we've made good profit while doing it. However, the good thing I like with hedging is in a case like this, okay, cool, the stock's gone extremely overbought, we started to pull back, but stocks do sometimes continue to run. And considering the calls are now worth, say $40, cool, you can kind of give yourself an extra $80 instead of losing that $80. But a lot of the times what I would like to do is kind of hold those calls and see what will happen with HPQ. So if we start to push up, again, they go in the money here at 38. Anything past there is going to be quite large and pure profit. So again, you can either hold the calls, which is what we're doing as of right now, or what you can do is basically re-enter this trade at better prices. So again, you can see here where we've been locking in our prices, and what you can see here is we're re-adding into these shorts coming into the end of the day. Again, that was a main trade. That is the trade completed. However, we still have those calls, so we can still define our risk. We short up to 200 shares with defined risk. So what we're looking at basically doing is reinvesting our profits, start shorting, coming into key levels. So again, we've got the intraday gap fill, so we expect price to reverse to there. A lot of times you kind of get that pull down further and look to target kind of that gap fill. In this case, it didn't fill, it continued to go, but we got short 40 there and another short 40 at the 6-month deviation. So what we can basically look to do is short another 40 here, another 40 here if we continue to push further up. Then in all in, we'll be in 160 shares short. And again, if we get that further move down, we can lock in those profits and obviously make money again on the short shares. And in the other case, if the price continues to rise, we're holding two calls. So if we start to break above $38, obviously these shorts will be losing money, but these calls, we are essentially long 200 shares at the same time with those calls. So even if we kind of could do a further move up and we get quite a big strong move to the upside, we'll still be making more profits even if we continue to hold these shares short. So that's basically the trade plan we had on HPQ. So I hope you enjoyed this breakdown. Let me know if you trade a similar way. Otherwise, I'll see you in the next one, and that's it. Peace.